There's been a lot of noise lately. You've probably seen it. Headlines claiming AI is triggering a massacre in software stocks. Commentators saying a major bank has quietly drawn a survival line. Companies on one side make it, companies on the other side don't. And the implication is clear. If you're holding the wrong names, you're sitting on a ticking time bomb. So in this video, we're going to slow this down. We're going to strip out the drama, remove the hype, and separate what's actually happening from what just sounds convincing. And by the end of this, you should feel calmer, sharper, and much more in control of the software exposure in your portfolio. Today is Saturday, February 14th, New York time. Drop the day and date you're watching from in the comments. I always find it interesting to see how these conversations age. Now let's talk about the narrative that's been spreading. The story goes like this. AI just crossed a line. Software is getting obliterated. Wall Street already knows who wins and who loses. And regular investors are the last to find out. Then they flash the numbers. A major software ETF down more than 20%. A large CRM name off nearly 30%. Tax and bookkeeping platforms sliding into the low 30s. HR and finance workflow systems down around 30%. Legal-focused names clipped sharply in what felt like a single session. And then comes the conclusion. This isn't a normal pullback. This is the market admitting AI is an existential threat. That word, existential, gets people emotional fast. Here's the issue. Individual facts can be accurate, and the overall conclusion can still be wrong. So instead of reacting, we're going to dissect this properly. First, what's the core claim? Claim number one. A new AI release, especially targeting legal workflows, spooked investors, and fear rippled across the entire software sector. Claim number two, a large research institution effectively created a winners and losers framework. If you're on the wrong side of it, you're in trouble. That sounds compelling. But when you slow it down, something interesting happens. Many of these viral posts trace back not to official documents, but to creator clips. And the pitch is usually structured like this. Institutions have a buy and sell list. You don't. I have access to the document. It's free inside my community. Serious tools cost a monthly fee. There's a live training this weekend. No replay. Now look, I'm not criticizing anyone's business model, but I am evaluating logic. Because your portfolio doesn't care how confident someone sounded. The first weakness in most of these arguments is how the numbers are framed. When someone says, this stock is down in the low 20s, your brain hears broken, but down from what? From a peak? From a hype-driven spike? From the start of the year? Those are completely different baselines. It's like judging a plane's altitude without knowing whether you're measuring from sea level or the runway. Same plane, different interpretation. And when you zoom out, the anxiety isn't only AI is replacing everything. There's another factor. We've spent enormous amounts of capital building AI infrastructure. Investors are starting to ask for proof. Proof that spending converts into durable cash flow. That's a return on investment audit. And even the largest tech companies have slid more than 20% from highs, not because their products failed, but because valuation expectations were stretched. So already, the one AI plugin destroyed everything story feels too simple. Now, did legal AI tools make people nervous? Yes. Legal workflows are expensive, repetitive, and highly structured. If an AI tool can summarize contracts, draft compliance documents, and handle checklists faster than a junior team, investors immediately ask, who was charging for that work? On top of that, courts have begun treating certain AI interactions as discoverable in legal proceedings. That turns a technology story into a liability story. And liability stories move markets. So fear hitting legal adjacent software first? That's logical. But here's where people jump too far. They hear legal AI disruption and mentally fast forward to every subscription software company is finished. They skip the middle, and the middle is everything. Think of the software sector like a mall. AI doesn't burn the entire mall down overnight. It replaces certain storefronts, usually the ones selling convenience at a markup. But stores wired deeply into the building, long leases, heavy integrations, embedded security, those don't disappear because a new shop opened across the street. So instead of panic, you need a filter. You need a way to distinguish fragile revenue from sticky revenue. Let's address the bloodbath language. Are parts of software down hard? Yes, but that doesn't automatically equal AI destruction. Sometimes it's valuation gravity. Sometimes growth deceleration. Sometimes stock-based compensation dilution catching up. Sometimes the market shifting from growth at any cost to prove profitability. This is a repricing. For years, markets paid premium multiples for growth alone. Now they want profitable, defensible, durable growth. And they want to understand which features can be replaced by a general-purpose AI agent. Here's the retail investor trap, treating software as one blob, bullish on software, bearish on software. That's like being bullish on restaurants. Some restaurants thrive in recessions, others empty out instantly. Same industry, different resilience. Now about that winners and losers framework. Institutions love creating baskets. They long resilient names, short fragile ones. It's positioning for uncertainty, not prophecy. But lists expire quickly. Once popular, markets front-run them. You don't need a PDF. You need a framework. So here it is, 3 lenses. Lens 1, liability. If software touches money, healthcare, national security, or regulated reporting, it isn't just automating tasks, it's documenting accountability. You don't casually replace systems where legal exposure exists. Lens 2, inertia. How mechanically difficult is replacement? Years of integrations, thousands of users, rewritten internal workflows required? If yes, disruption creeps in slowly, not instantly. Lens 3, infrastructure. AI runs on compute, storage, networking, cybersecurity, and data pipelines. As AI adoption rises, that plumbing becomes more valuable, not less. Data centers scaling, power delivery constraints, enterprise guardrails expanding. That's physics, not hype. Now let's connect this back. If a software product primarily wraps a repeatable document workflow and doesn't own risk, it's vulnerable. If it's deeply embedded in regulated systems, distribution networks, or enterprise governance, disruption is slower, and ironically, legal AI risks may increase demand for security, compliance controls, and policy management tools. Same theme, different outcomes. Now let's talk about the phrase, AI can do what software companies charge for. Almost free? Sometimes, but almost free is rarely free. Costs shift from subscription to compute, from workflow tool to integration oversight, from human labor to new supervision layers. If you only ask, can AI do the task? You miss the bigger question. Where do the costs reappear? Now let's make this practical. Open your portfolio. Write down the software names you actually own. Run each through the 3 lenses. You'll find something interesting. Some boring names are extremely hard to displace. Some exciting names from the easy money era were selling convenience with low switching costs. Those get punished first. And if you look at how institutions frame resilience, they tend to favor large cloud and infrastructure platforms, security and identity control systems, data infrastructure and network plumbing, government-embedded analytics tools. On the fragile side, attention often falls on per-seat pricing models and sales orgs, automation-friendly tax and bookkeeping systems, HR workflow platforms, per-seat pricing models and sales orgs, automation-friendly tax and bookkeeping systems, HR workflow platforms, basic signature platforms, outsourcing heavy consulting names, lightweight project and marketing automation tools. Outsourcing heavy consulting names, lightweight project and marketing automation tools. This isn't a buy or sell recommendation. It's a map of how capital is thinking. Now, here's the part most people get wrong. It's a map of how capital's thinking. Now, here's the part most people get wrong. AI being powerful does not automatically make a company a good investment. If a stock is priced for perfection, even operational success can disappoint shareholders. That's why this audit feels harsh. So here's a simple action plan. Step 1, inventory. Know what you own and why. Step 2, categorize using liability, inertia, infrastructure. Step 1, inventory. Know what you own and why. Step 2, categorize using liability, inertia, infrastructure. Step 3, set rules before emotions show up. If pricing power disappears, reassess. If growth slows and dilution rises, demand discipline. If AI spending surges without cash flow clarity, monitor returns. If pricing power disappears, reassess. If growth slows and dilution rises, demand discipline. If AI spending surges without cash flow clarity, monitor returns. Most retail investors struggle with selling. They don't sell losers because of pride. They don't sell winners because of greed. They don't sell winners because of greed. They don't sell losers because of pride. Then they call it long-term investing. Execution matters more than opinion. Now, let's land this. AI disruption is real. Execution matters more than opinion. Now, let's land this. AI disruption is real. That's storytelling. But the idea that one release flipped a switch and doomed an entire sector overnight? That's storytelling. What's real is a shift from blanket enthusiasm to selective discipline. Markets are separating fragile business models from durable ones. That requires work. It requires thinking. If you got value from this breakdown, subscribe and comment John AG, so I know to do a follow-up applying this framework to specific real-world examples, calmly without hype. As always, this is educational content. I'm not your financial advisor. Do your own research and make decisions aligned with your situation. Think clearly. That's the edge. Think clearly. That's the edge.